Hey there, hope all is well. Back at you today with more RTD news updates. And as always, if you find today's articles to be informative as well as educational, feel free to share with our family and friends to help them become more monetarily aware. And if you're new to RTD, click the subscribe button below for more RTD news updates as well as interviews. Let's get into today's articles. Well, today we'll cover a variety of topics, predominantly dealing with debt, currencies, and the markets. And the first one here is it's official. U.S. government ends fiscal year with 1.4 trillion debt increase. Second article from Merck Funds, the end of dollar dominance. Third one from Reuters, stronger yen, not inflation, will trigger Bank of Japan easing. Next one from the Independent, pound sterling value hits new record 31-year low against the dollar. Next one from the Daily Reckoning, the most dangerous man in America is Mr. Larry Summers. And the last article here is from Bill Gross from Reuters, and it's of Janus report. Bill Gross of Janus warns financial markets have become a Vegas casino. So let's go back to the first one and dive right in. So here's an article from Sovereign Man entitled "It's Official: U.S. Government Ends Fiscal Year with 1.4 Trillion Debt Increase." And it's a quite lengthy article, but yet quite humorous, yet informative all at the same time. And I'll just go through a little bit of it here. It says, "It's official. The United States government closed out the 2016 fiscal year that ended a few days ago on Friday, September 30th, with a debt level of 19 trillion 573 billion 444 million 713,000 936 and 79 cents. That's a large number. That's an increase of 1.4 trillion 422 billion 827 million and 47,452 and 46 cents over last year's fiscal year close. Wow, that's a large number to repeat. Incredible, by the way, that debt growth amounts to roughly 7.5% of the entire U.S. economy. By comparison, the Marshall Plan, which completely rebuilt Western Europe after World War II, cost $12 billion back in 1948, or roughly 4.3% of U.S. GDP. An initial appropriation for the WPA, perhaps the largest of Roosevelt's New Deal, make work programs that employ millions of people, cost 6.7% of U.S. GDP. And more recently, the U.S. $700 billion bailout at the beginning of the 2008 financial crisis, which was equivalent to 4.8% of GDP. So basically, these people managed to increase the national debt by a bigger percentage than the cost of the New Deal, the Marshall Plan, and the 2008 bailout. So what exactly did you get for that money? Did they spend 1.4 trillion on achieving world peace, eradicating poverty, saving the planet, or some other pipe dream? Did they finally fix American crumbling infrastructure? Did they send a gigantic refund check to every American woman and child? Actually, the answer is D, none of the above. They squandered it all. In fact, 2016 fiscal year had the third largest increase in government debt in U.S. history. The only two previous times in which the debt increased more than 2016 fiscal year were during the financial crisis. But there was no financial crisis in 2016. The government didn't have to spend money, to spend hundreds of billions of dollars to bail out banks, all things considered. 2016 was a pretty normal fiscal year for the federal government. There were no major emergencies to drain taxpayers. Yet they still managed to spend 1.4 trillion. So it goes on and on and on. And he basically says that it's going to come a day where they can't actually pay this back, and they're going to need to borrow more because most of the social programs, such as Social Security and Medicare, are already well underfunded. And it says here the disability insurance is already depleted. So it's going to come a point in time when they have to choose between defaulting or basically, you know, end up defaulting, but yet on who? Whether it be the taxpayers or on the financial institutions and banks that they owe this money to. And he says basically, which one do you think they're going to default on? And I would be led to believe that they'll default on the people first before they let the institutions and banks go under. So, good article here if you guys are interested. Scroll down below. Here's the second article here from Merck Funds by Axel Merck, "The End of Dollar Dominance." And so it's a quite lengthy and detailed article, but the gist of it is leading to the idea that when it comes to money market funds, there are some things that are changing, which will ultimately affect the LIBOR rate, or the rate at which institutions borrow dollars be outside of the U.S. And so basically his point is that, with all the U.S. debt that's being held, outside the USA, it's going to become more expensive to do business in dollars, which will make the euro rather more appealing to borrow in, so that the transaction can be done. And so basically, he goes through a lot of details here, explaining why and what his thoughts are behind the fact that, you know, these new rules that are being implemented into the market funds are really going to cause, you know, debtors to really rethink, you know, in what currency they borrow, which means that, you know, there'll be less of demand overall for dollars per se, which will play into the idea, as he says here, the end of dollar dominance. And so he actually gives a couple of charts here, talks about how, you know, with Saudi Arabia, they're getting away from holding U.S. securities, and so that's on the decline. And then he goes to another one here talking about just the bank funding cost is rising. And that's the whole LIBOR exchange rate, which is going up, which he foresees going up for quite some time, or staying at that same rate, which will make the dollar less appealing when it comes to borrowing for emerging markets' sake. So other than that, it's a lot of other technical stuff in here that I'll let you go through if you're interested. But yet, definitely, he's using a more of a technical approach on why he believes the changes in the money market account area will begin and creating less of a demand for dollars when it comes to borrowing dollars, just because it's going to become more expensive. So anyway, interesting article. If you're interested, check it out below. Here's an article here from Reuters, and it has to do with stronger yen, not inflation, will trigger Bank of Japan easing. And ultimately, it boils down to just the Japanese deciding and needing to keep the yen low as possible, and for it not to increase in strength. And so here it talks about the Bank of Japan would deepen negative interest rates to thwart any sharp spikes in the yen, which the central bank sees as an obstacle rather to stoking inflation and economic growth. While achieving its inflation target remains the Bank of Japan's top policy priority, the bank's dwindling toolkit means an abrupt yen rise rather than struggling inflation. If excessive yen rises hurt the economy, the Bank of Japan won't hesitate to ease. That's funny they use the word ease, or to counterfeit, said one of the sources. What's important is to sustain the economy's momentum to hit 2% inflation. The dollar stood around 102 yen on Tuesday, not far from the psychological barrier of 100 that was almost breached when the pair fell to 100. Then he goes on to say, for the past 3.5 years, the Bank of Japan relied on massive injections of money into the economy to keep the yen weaker. But last month, the Bank of Japan switched the focus of its stimulus program from buying bonds and risk assets like trust funds investing in stocks to targeting yields. In January, the Bank of Japan pushed interest rates on some bank reserves with the central bank below zero, hoping real interest rates would fall and thus stimulate consumption and investment. So the goal is ultimately weaken the currency, force you to spend it, so it keeps the wheels turning in the economy in Japan. But there is not much room to deepen negative rates or cut the 10-year bond yield target below zero, given the damage such moves could inflict on Japan's banking system. And it says, Kuroda acknowledged on Tuesday the Bank of Japan could be less aggressive in expanding stimulus given the hit to financial institutions suffering from narrowing margins. In guiding monetary policy, we will take into account not just how our policies affect lending rates and the economy, but how they affect the finance sector. So it goes on to talk about, you know, some more detailed things as far as how Abenomics is, you know, really not working. And then how this all ties into what the Fed is doing with their expectation of raising rates or not. And if they don't, how it'll keep the dollar stable, if not weaken it, which will be a problem for Japan. So all in all, monetary policy is, you know, truly failing at the people's expense. And so the idea of keeping the currency weak, so it forces people to want to spend it and to consume more, is just a flawed policy model. But we'll see how it turns out. Articles below if you're interested. Here's an article here from the Independent out of the UK, and it's in regards to the pound. It says pound sterling value hits new 31-year low against the dollar. And so this all has to do with the whole Brexit ordeal that happened over the summer, and how the negotiations are playing out for the days ahead. And so here, just to give you an idea of what's going on, it says fears of the consequences of a hard Brexit have sent the pound tumbling to a new 31-year low against the dollar. Speaking at the Conservative Party annual conference in Birmingham on Sunday, Theresa May has ended weeks of speculation and revealed that she will launch formal Brexit talks with EU leaders before the end of March 2017. The timing means that UK looks to set up to leave the EU by summer 2019. And then it gives a little information about the sterling. It says sterling has fallen to $1.2764 in early trading on Tuesday, extending its loss from the previous day. That is the lowest level since June 1985 and almost 15% weaker than before the EU referendum on June 23rd. Meanwhile, despite the drop, FTSE 100, as well as I think the 250 and small caps from what I've heard earlier, have all risen amongst the idea that the pound is weakening, but yet their markets are, showing signs of strength. So that kind of seems counterbalancing to me, in my opinion, that the currency is weakening, but the trading with companies is going up and denominated in the pound. So, but anyway, so more information here on the whole Brexit ordeal and some quotes from this meeting here that is right here. But other than that, if you're interested, check it out. But other than that, just the historical lows with the pound. So that means that everyone who's actually holding physical pounds or pound denominated digits in their accounts or whatnot have all lost some purchasing power in comparison to the dollar, while those that may have held metals in the form of gold and silver have actually absorbed some of that loss from the paper. So it's probably a good day for those who have more metals than paper at this point, because they've gained a little purchasing power. So interesting story below if you're interested. Here's an article here from the Daily Reckoning, and it's The Most Dangerous Man in America, and it's referring to Larry Summers by Michael Covell. And basically it just points out how just recently Larry Summers, I guess, has suggested, based upon Janet Yellen's congressional testimony, at the idea of eventually, if something does happen, or as a way to really begin, getting the wheels turning a little bit faster in the economy when the sectors are slowing down, it might be a good idea to start purchasing stocks, or common stocks rather, just to keep this party going a little bit longer. So this author goes through, just talks about how, Larry Summers, how he's he's been groomed well throughout the years. It says 1983 became one of the youngest tenured professors in the history of Harvard at age 28. He joined Bill Clinton's administration before he turned 40. He then served as president of Harvard from 2001 to 2006. In 2009, he joined the Obama administration to direct the president's economic policy before leaving in 2010. So he's quite accomplished. And so he goes on to talk about, if you want to know why Summers' return to power in Washington, D.C. should scare the hell out of every man, woman, and child in America, consider the bone-chilling words he uttered last week. Summers was speaking at the Bank of Japan conference in Tokyo when he floated the idea that the U.S. government should consider purchasing a wider range of assets on a sustained and continuous basis. Translation: the Fed should buy a ton of stocks to artificially boost the stock market and economy. Well, the economy is struggling and with stagnant growth and inflation, and according to Summers, the Fed is fairly near the end of the rope on more fixes. So, Larry Summers, obviously a very intelligent man, mentions that the Fed is nearing its end on what it can do. Implicit in the argument is the admission that the Fed's extraordinary stimulus measures of the past 8 years to create robust growth and boost inflation have done squat. So now that the Fed has failed and is seemingly out of bullets, what does the smartest guy in the room propose? You might think he would stop, pause, reflect on the obvious mistakes made back in 2008. No chance. Elite water boys like Larry Summers like to be memorialized in history books, serenaded for their creativity. Their egos must be dreamt up by Ponzi schemes. It justifies their existence. But what are these new ego trips of having government backers, hacks, use taxpayer money to indiscriminately buy common stocks to prop up stock market? Well, we know. Don't have to joke about the government picking winners anymore. Just told you they will. Did you just start humming Beatles? Yada, yada, yada. So anyway, you go and talk about the end of capitalism. Summers' diluted world. No longer do you need to adequately concepts like supply and demand, or for that matter, capitalism to determine market prices and economic growth. Just hand over citizens' money to enlightened men like Summers, and they'll decide what's right for all of us, just like Miles, Stalin, Castro, and Chavez. Bottom line, Summers is proposing pure socialism, full stop, and he knows it. From a Bloomberg article on his Tokyo remarks, quote, there are obviously important political and economic questions associated with government ownership of companies, Summers noted. Some critics would term such a policy as socialism, he said. It's not critics who term government ownership of public companies as socialism. The dictionary does that. Excuse me. So it goes on and on. But basically, consider yourself warned is what he's saying, that when Larry Summers, a economic think tank guru who's been pretty much a part of all the fiasco that's transpires in 2008, when he starts talking about him, the government, and the Fed getting into buying stocks and properties and assets directly, you know there's trouble brewing. So articles below if you're interested. Here's the last article from Reuters here, and it's in reference to Bill Gross of Janus, warning that financial markets have become a Vegas casino. And so it starts off by saying global central bank policymakers have turned world financial markets into a casino thanks to their unprecedented monetary policies, bond investor Bill Gross of Janus Capital Group warned on Tuesday. Quote, our financial markets have become a Vegas, Macau, Monte Carlo casino, wagering that an unlimited supply of credit generated by central banks can successfully reflate global economies and reinvigorate nominal GDP growth to lower but acceptable norms in today's highly levered world. Gross said in his latest investment outlook titled Doubling Down. Gross, who oversees the 1.5 billion Janus Global Unconstrained Bond Fund, recommended Bitcoin and gold for investors who are looking for places to preserve capital. Now you know something's wrong with a major investor managing 1.5 billion in people's funds says that he or is quoted or mentioned as recommending Bitcoin and gold for investors. I wonder is he actually telling that to his actual clients that he's holding the 1.5 billion for. At some point, investors leery and indeed weary of receiving negative or near zero returns on their money may at the margin desert the standard financial complex for higher returns or better yet, less risky alternative, Gross said. Gross has been lambasting ultra-loose central bank policies for hindering global economies by keeping so-called zombie corporations alive and inhibiting creative destruction. For several years, Gross and others have warned that zero negative interest policies not only fail to provide an easing cushion should recession occur, but they destroy capitalism's business models. So he goes on for a couple more quotes, but end of the day, we are now in a world where financial markets by well-known individuals such as Bill Gross considers it to be more of a Vegas-style monetary environment we're in. So when he recommends or is quoted as recommending Bitcoin and gold for alternatives to preserving your wealth, those are signs of the monetary time. So this is the end of today's news updates. Hope you enjoyed it. As always, feel free to share this with our family and friends to help them become more informed on their money. And also, if you're new, subscribe. Looking forward to bringing you more RT News updates. Until next time, see ya.